Passive Pockets is presented by Equity Trust. We are back with another episode of Dig In or Delete. On our last run, we broke down real investment deals straight from our inboxes, and the response was incredible. We got so much thoughtful feedback from listeners who appreciated the raw, real-time analysis, and they wanted more. So here we are, back for another round. Welcome to Passive Pockets, the passive real estate investing show, brought to you by Equity Trust. I'm your host, Jim Pfeifer, here with Paul Shannon. If you're a passive investor, you know the drill. Your inbox is packed with syndication deals, all claiming to be can't-miss opportunities. But how do you quickly sort the solid from the shaky? That's what we're here to explore. In this series, we're reviewing actual investment pitches, no hypotheticals. We'll walk through the structure, returns, assumptions, and everything that catches our attention, good or bad. Then we'll decide, dig in or delete. Just a quick note, this is not financial advice. This is not a recommendation to invest or not invest. It's an educational deep dive into how experienced investors analyze new opportunities. And we want to keep improving this format with your help. Got a thought? Want to see different types of deals? Shoot me an email at jimpfeifer@biggerpockets.com or drop your feedback into the Passive Pockets forum. All right, Paul, let's take a look at our first deal of the day.
Okay, so the first deal we have here, Jim, is a multifamily property in Seattle, Washington. It is described as an incredibly low basis. It's only 9 units, so it's a pretty small deal. We've got a purchase price of $195K a unit, which they say is 22% below assessed value and 30% below current market value.
So just so I understand, so far, Paul, it's about $2 million total for the deal, right? If there's 9 units at $200,000 each, we're basically $2 million.
Touch below. Quick math. All right, we're on the same page here. Post-renovation, they say distributions of 11 to 14%, and that will start as early as month 7 or 8, and then they plan on doing a cash-out refinance in year 2 due to the appreciation they intend to force. IRR of 18 to 21%, depending on the acquisition loan, the interest rates, and individual equity investment amount. Different investment classes, although they don't state what those are here. The cap rate at purchase price is a 9.75 going in. Cap rate on full cost basis, quote unquote, is 7.6 with a market cap rate of 4.7. Conservative underwriting, there's a lot of information here. I'm just going to try to keep this concise. I mean, what do you think so far, Jim?
I mean, it's small, which I don't know if that makes me nervous or not. I think Seattle's interesting. I don't have anything in Seattle, and part of this for me is when I'm faced with a new market, that automatically piques my interest. You know, those numbers sound high to get cash flow of 11 to 14% in 7 or 8 months. So it must be, I would assume that maybe all these units are vacant and they're in 7 months, they're going to go and renovate all of them. If I understood that plan a little bit better, I might be able to get a little bit more comfortable. Typically, we say we don't like it when they bake into their pro forma a refi because you just don't know what it's going to be like. But if all the units were vacant and I knew they had experience in renovations, then it's almost like a development deal, right? Because you're doing a big renovation with everything and then you're financing out of your construction loan, maybe is kind of how I would look at it. So that doesn't, baking it in this one isn't as egregious, I guess, as I would typically think. So I think this would be one that I would probably take one step further. I'm not super excited about it, but I'm not against it, right? It's not an instant no. It's kind of I'll tentatively dig in and just maybe read the email another time and maybe go to their website.
Like a lot of these deals that we look at, especially with sponsors that we're less familiar with or haven't invested with before, there's more information to gather here. I think there's a lot to leave to the imagination from what I'm looking at. I know you don't see this and I'm just talking to it, but they don't talk about their splits or their preferred returns. They say there's just different share classes. So we have to reach out and find out what those are. The refinance, yeah, to your point, I mean, if it's a deeper value add type play, that's sort of necessary. For me, when I think about coastal markets, I think about less landlord friendly. And then you've got these small assets that are 9 units. That's pretty common in like older cities, coastal markets. But you got to think about what's the exit? Who's the buyer after these guys sell this?
Yeah, good point.
I don't know. Maybe there's a big appeal in that market for smaller assets like this.
And I guess the question I would ask is, why it's so small? Why is it being syndicated, right? This kind of deal where it's $2 million and maybe they're raising more for the renovations, right? So maybe there's $3 million, but even that, is it worth it to syndicate a deal for $3 million. Are you telling me you don't have friends and family that you can raise $2+ million from? Well, that's a red flag. And then you mentioned 3 different cap rates, and that kind of confused me. You're more into cap rates than I am, but you went all the way from a 9 to a 4 and then something in between. So I would dig into that a little bit more because that was confusing. But this is something, it's so unique that it might be worth looking at. That's kind of how I look at this stuff. And again, I'm a guy who always has to force myself not to chase the shiny object. But Seattle, Washington, small deal, seems like complete rehabs, just guessing. It's interesting to me. That's all.
It is interesting. I think your point about it being more of like a joint venture with a couple people involved versus a syndication is real. I'm not sure why they wouldn't just want to hang on to the equity and drive the returns. Maybe they're building a company and this is one that they can fit into the mix, but otherwise they would do on their own. But they just want to attract investors and kind of build relationships with outside capital. I guess I can understand that. And then your comment about the cap rate on purchase price was stated at 9.75. And then they go on and they say cap rate on full cost basis. I don't know if that means yield on cost. I assume it does, but it's 7.6. So that would indicate to me that if I'm understanding this correctly, and I want to ask about this, they're putting a lot of money into it and they're actually lowering their operating yield. So is the value add plan really worth doing? Why not just hold on to it, even if they're older units? If it's running at a 9.75 cap rate, why put more money into it? Maybe it's to attract buyers who are looking for a really stabilized property. They say that the submarket cap rate for Q4 of 23 is a 4.7, and they're underwriting to an exit cap of 6.
That's a red flag for me. Baked into my investing is exit cap rate should always be higher than your entry cap rate, right? And again, this one has unique reasons why it's different, but that was kind of always baked into me, is always look for a higher cap rate because you don't know what the market's going to do. You can only control what you do to the property. You can't control where the market goes. So that would make me a little bit nervous just based on my priors, right?
I mean, 9.75 cap rate is in my local market, like a tertiary deal that's a C-class property with some tough tenants. I don't know, Seattle could be different, but Seattle is a pretty big market that has good population growth. And I don't know the market that well either. So I guess I would be, with it being a smaller asset, for me, if I had capital allocate, I probably wouldn't dig too much further in this one. There's nothing necessarily wrong with the deal. It's just, it's not going to catch my attention for too long.
Yeah, I think we can move on from this one. I'm kind of a slight dig in because I'm interested in chasing the shiny object, and Paul's kind of a slight not dig in because there's a lot of questions. Let's move to the next one. I got one that the headline is the first opportunity we have liked in 3 years. And this is a 97 unit townhouse community in Dallas, Fort Worth. It is 42% below today's replacement cost. They have a 3.07 fixed rate loan for 5 years. That must be assumable, I'm guessing. I don't know how else you get that. 1.6 million in projected interest savings compared to new financing. 7.5% average cash flow to the LPs. And then 16% average annualized at a target 4-year exit. Let me see. There's a few other numbers in here. So there's 2 options. Class A shares, 10% preferred returns, no upside, and you're right behind the lender in the capital stack. And then they have the Class B where you get a 5% pref, a 70-30 split after that, which is better than the split this particular operator used to do, until a 15% IRR hurdle is met, and then you're at 50-50 split. So that's all the information we have, and then they, obviously give you links and stuff. So just with that basic information, what are your first thoughts about this one, Paul?
Well, Dallas is one of the most sought after markets as far as investing in multifamily. It's been a bellwether for the space for a while, attracted a lot of capital. I think there's pockets of Dallas that are probably set to outperform over the coming years, and then there's pockets that maybe aren't. So I'd kind of want to know where it sits in the submarket and understand that a little bit better. I would be talking to people that I'm connected with down there, or find people to connect with down there that know more about Dallas, because I think it's just a market that's really spread out and saturated, and there's areas that are doing really well and not, and I just don't know the market that well. 3.7% interest rate for 5 years, that has got to be an assumable.
3.07.
Oh, 3.07, even better. What's the leverage?
They didn't say. The one thing that I didn't like about this presentation is they say $1.6 million in projected interest savings compared to new financing. And you already have the financing, so it's not a savings, right? Because you're not doing the one finance. So they're kind of manufacturing stuff. Like there's enough to highlight about this. I don't like the fact that they highlight something that isn't really happening. I'm
not sure. I really don't know what I would do with this one. I think it's probably just not going to catch my attention, I guess. It's kind of small. There's probably not institutional interest from, 70-something units?
97, yeah.
Not something that's getting me overly excited, and I'm not sure why.
I get that. It's from an operator that I've kind of had some bad experiences with, and so this is their first deal in 3 years. So we're not supposed to focus on the operator, we're focusing on the deal here. But me personally, I would want to see how they do before I get right back into it. Some of the things that I'm seeing now, they say 16% average annualized return at a 4-year exit. Why a 4-year exit? And that has to be probably tied to the interest rate that they have for 5 years. And one thing, they say 5+ years, but one thing that Brian Burke says is you want to make sure that your deal can run for 10 years, right? Because on almost any 10-year cycle, you're going to be up after 10 years. And I don't like that they have a 4-year target, because that's what got them into trouble with the other deals that I'm in with them. So that makes me a little bit nervous. And then bragging about 42% below today's replacement cost. I don't know. I guess that's good, but that doesn't really tell me much either. So this is one that I would probably look into a little bit, just because I'm curious. This is a pretty major operator and they're back in it. So I'd look into it, but I definitely wouldn't participate in this one, because I want to see how they do after having struggled for the last few years.
That's a great point about the business plan and the 4-year time horizon. I think it would be really important in this scenario to have the sponsor explain what their plan B is and kind of stress test through some sensitivity analysis what different refinancing scenarios would look like if they couldn't sell the asset. Get comfortable with the idea that, yeah, we'd like to see the upside at year 4. That would be nice. But if the macro picture isn't what it is now and things change dramatically, like, what are they going to do with this thing? There's got to be an alternative to handing it back to the bank. So how are we going to get new financing? And would that potentially lead to, the need for an influx of capital? Because if they're at a 3% interest rate today, and rates today are at, much higher than that for a property this size, I'm guessing they could get into the mid 5s, maybe high 5s. That's a completely different scenario. That's going to put strain on cash flow. They've got to grow NOI quite a bit to get that up to refinance. So
that's a great point, because what we need to remember in this is, let's say they could get 6% just to keep it easy, right? So you're going from a 3% to a 6%. That's a small little 3% jump, but it's a double, right? It's doubling the cost. And so now your interest payments are double what they used to be. That's exactly what got people into big trouble. And so I would be very concerned about making sure that the debt, they said 5+ years. Well, what does that mean? How long do you have it? All of that really needs to be specified and ironed out. But I think we can summarize that we're both kind of probably delete this one. Part of it is just to wait and see and watch and see how they recover.
All right, Jim, this is a one that I've been excited to kind of share with you, because I know you live sort of right down the street from this asset. And it is a sponsor who's raising capital for a ground lease to BJ's Brew House in Dublin, Ohio.
Oh, wow. Okay.
It's an affluent and fast-growing suburb of Columbus. I mean, you live there, so it's got to be.
Absolutely.
This location stands out with over $4.3 million in annual tenant sales, 0 landlord responsibilities, and a long-term lease through 2031. What makes this deal truly compelling is the strategic positioning it gives us. BJ's has only one renewal option remaining, giving us leverage to negotiate a favorable extension or take ownership of a $7 million building at no additional cost. BJ's corporate real estate director has expressed interest in investing $1 to $1.5 million in capital improvements at this location, reinforcing the long-term value of the site. It's about $3.8 million. The cap rate today going in is 7.85, and it's going to bump to 8.64 in 2026 because of a 10% rent increase. Projected IRR 15 to 19% with a pref of 8, minimum investment of $100K. What are your thoughts, Jim?
Well, I know that place. I've been there. I've eaten there, and it's right next to a large mall that is dying, maybe? I don't know. That's a tough one. So you said it was a 3-point-something million deal, but the buildings were 7. I don't really understand that. I'm totally biased, right? Because I know this town. Now, Dublin does a great job with infrastructure, making sure, that the town is, all the buildings are taken care of, right? So that makes me feel good about it. The thing that doesn't make me feel good about it is this is right next to the highway, but it's part of this mall, right? It's right across not even a real road, but it's like part of the mall almost. And I just don't know what they're going to do with that mall. I mean, there's a ton of properties and apartments and things around it. They get a lot of traffic at that location. So I think the challenge for me is I'm so familiar with this location that it is kind of paralyzing me from both sides. You said they have one more rent increase. So I'd really want to look at the financials. I'd want to know, how is BJ's doing? Part of this is you have to underwrite that company, because you're not in a fund. Like I'm in some triple net lease funds where Rite Aid went out of business. And so the funds are struggling because they had 2 Rite Aids, but they had like 6 advanced auto parts or whatever. So those kind of help you out, right? But if you're just doing one, I would be a delete, probably just because it's one single location and I might be too familiar with it. I wouldn't want to do it because it's one location and you have too much risk, and I don't understand how that mall is actually surviving. And I drive by it all the time and there's no cars in the mall parking lot. There's always cars at BJ's, but I don't know how sustainable that is.
I'm glad that I brought this one to your attention, and I'm sort of glad that you answered the way you did, because you highlight something so important as it relates to being a passive investor. You see the name Dublin, Ohio, and maybe if you don't know Dublin, you're like, let's look it up and let's find some information on it. You could pull CoStar reports, you could pull all kinds of data from, the census website. Whatever you can find on the city is going to tell you that it is an up and coming, affluent area with lots of great jobs and tons of new development, et cetera, et cetera. So you think, okay, that's how the whole town is, right? But that specific pocket of the town, as I know it, and that mall being right there, is sort of dying. And this is a, out parcel of that mall. And knowing that information is so powerful and so important, because real estate is so local. And having local insights and, that unfair advantage is what's key to driving returns. And I don't think that this syndicator lives anywhere near this asset. So maybe they're pulling the same information I just mentioned, and they see all these flashy numbers like, oh, this is a great area. Well, that specific area, it's not like it's a rundown market or anything. It's just there's not a lot happening on that specific pocket of town. And that would concern me as well. So having that local knowledge is so important. If you're evaluating a multifamily deal in Seattle, for example, like we just talked about, you're going to want to find somebody that has that local insight, right? So that's key. Your other question about the cost, it was $3.8 million. Because it's a ground lease, that means that the syndication will own the land, but BJ's owns the building. If they decide to vacate the building, then the syndication takes over the building as well, and they'd have to find a new tenant. Sounds like a good, potential situation to be in. If they get a new lease, that's great. They've got a new triple net, absolute net lease they can sell to another investor. If that restaurant decides to vacate, they've got to find somebody else to take over that building. They're probably going to have significant tenant improvements that are required. It could be another restaurant, could be something else, but is there going to be a tenant that's attracted to that area because of the dying mall that it sits next to? I don't know. So very interesting deal. I haven't seen one like it in quite a while, but I think what we can take away from this one is that location really matters, and local insight is so important when it comes to passive investing.
The two main things for me are uncomfortable with location, but only because I have knowledge about it. But the real kicker is I just don't like one restaurant triple net lease, because if that goes vacant, you might be able to get someone else in there. I'm sure you would be able to, but there's a property, a Pizzeria Uno or something that was, a half mile from this location that stood empty for 3 years. And that is a deal killer. So I'm definitely a no on this one.
Very good.
All right, the next one, let's try this out. This is a development deal, and it is also the first time in 3 years that this particular operator has found a project they believed worthy of investment, but they are bolded. We're extremely excited. So they're super fired up about this one. It's a development deal, a 351 unit ground up Class A multifamily complex. It's part of a large master planned community that is fully entitled, that'll have retail, restaurants, townhomes, and a medical center. It's just southwest of Dallas in Claiborne, Texas. It's the home of the Railroaders professional minor league baseball team. And this development will be right next to that stadium that's going up. It's going to be a 3-year hold, projected annual returns in the 23 to 25% range with 6 to 8% preferred returns. Investor splits are either 80-20 or 90-10, so they must have different share classes. They are in the process of finalizing tremendously favorable financing terms through HUD, locking in a 40-year assumable loan with up to 3 years of interest only. The GP team is going to purchase at least 5% of the total equity raised, and there's a bunch of depreciation that you can get on this, and that is the information I have. So, Paul, what do you think?
What I know of Dallas is that it was sort of oversupplied. When money was cheap, developers were getting a lot of stuff out of the ground. Too many units to absorb, been relatively robust. And I think, as we've talked about in prior recordings, that those units are going to get absorbed eventually, and it's very difficult to get projects out of the ground today. So what does get delivered presumably when this product finishes in say 27, 28, there'll be limited competition. So I kind of like that, assuming that the track record is strong from the group.
Track record is strong, but I don't know that they've done development before.
That's a concern for me. I think development is a completely different animal than, going in and fixing up units versus building them from the ground up. So I'd want to look into that a little bit more. I like the fact that it's next to the stadium. I think that's attractive as an amenity for tenants to move there. I don't know much about Claiborne, but, assuming it's growing like much of the city there. HUD loan, 40 years. That's interesting. I'm not much of a development guy overall just because I'm a cash flow investor, but I think that there are some unique dynamics in the market now that have led me to kind of consider development a little bit more, just because of what we talked about supply kind of taking care of itself and not many projects coming out of the ground today. I think those developers that have those unfair advantages, that have economies of scale, that understand how to keep projects moving and kind of have that unfair advantage, to use that term again, they're going to do really, really well. My concern here is if they haven't done this before, they're not one of those groups that has that unfair advantage. So for me, that would be a pass.
I'm not 100% sure they haven't done this before. That's just my guess. And that's the first question I would ask. I'm trying this new thing, the Lopez ladder, right? We got this from Chris Lopez, where, you do a development deal every year, and eventually, even though I'm a cash flow investor, eventually I'll have cash coming in from these deals. So I've been seeing a lot more development deals lately, which is interesting. I kind of go back and forth on this because I also don't want to be anyone's guinea pig. So if they haven't done a development deal before, I would be a lot more hesitant. But what I like is it's Class A. It's part of this large master planned community that's already fully entitled, that has restaurants and shopping and all this other stuff. So other people are heavily investing in this area. They're building a new $25 million baseball stadium. So people putting up that kind of money are also doing their due diligence and saying, this is going to work in this area, right? So there's a lot of things going for it. I love the HUD loan. So this would be a dig in for me. And again, part of the thing I would really focus on is the experience of the operator and how they're doing development and how they've got all those boxes checked. So I'd be cautious, but it's a really interesting deal for me, and so it's definite dig in.
I guess I would piggyback on that, and if they have experience in development and a track record with getting projects out of the ground, I would probably dig into, given the location, the HUD loan. Without the experience, I would say no.
All right, give us another one, Paul.
Okay, on to the next. We've got a grocery-anchored shopping center in Lake Charles, Louisiana. It's 166,000 square feet. It was rebuilt in 2022 with over $32 million in improvements. They consider it a core plus investment. It's being acquired at approximately 50% of replacement cost. It's anchored by a large grocer, Market Basket, who's been a tenant for 40 plus years. The center is 90% occupied with a rent roll that is composed of sticky service-based national brands, strong in-place income with upside from leasing, almost 15,000 square feet of second generation space and below market rents averaging $12 a square foot versus market rates of $16 to $24. Projected returns include a 12.1% net IRR, 2.1x equity multiple, and an 8% preferred return over a 5-year hold.
Okay, my first question is, how do you get such a low IRR with the higher return? So I'd want to dig into that math a little bit. If you get a double in 5 years, I don't see how you're only getting a 12% IRR. But again, I'd have to dig into that. The thing that really sticks out for this one is I've never, ever seen a syndication in Louisiana. I automatically perk up like, what? Louisiana? I don't understand how this property could be so distressed if they just put $32 million into it. And then that answers my question. It's probably just so distressed because they put $32 million in it right at the time when interest rates were really changing, right? So I'd want to dig into the story behind this one. What's happening? I love retail, and I like it when there's out parcels that you can sell off or do something with, because I think there's a lot of good value add there, but it's really slow value add to where it's almost like development, because it is if you're developing an out parcel or selling off an out parcel. So it's a little slower moving. So this is a kind of in between for me, and not being familiar with the market. I probably wouldn't dig into this. This is probably one that I would delete just because there's so many unknowns, including, I don't know anything about Louisiana. I don't understand, are there out parcels or not? Is there that value add component? And I'd want to know the story of the property. But for me, I'd probably pass and look for something else in the retail space.
I'm with you. I don't know Louisiana. Lake Charles is probably considered a tertiary market. And for a 12 IRR, in a tertiary market. I just think that leaves a lot to be desired from a risk-adjusted perspective. I think there's alternatives in just this space as we talk about syndications to earn, a better return and take on potentially less risk. For big grocery anchored properties like this in tertiary markets, I think there's kind of a limited buyer pool too. So I'd be concerned a little bit about exit. And I agree. I don't know how they get to a 12 IRR with a 2x multiple in 5 years. If it was like a 10-year hold, that might make sense a little bit more, but it doesn't necessarily add up. So I'm not sure where that number's coming from. I might want to look at the underwriting file, talk to the sponsor. Sounds like they've got a really good track record here. I didn't mention that. They've got over 25 years of experience and quite a bit of experience within this asset class. So interesting, but again, I think the returns are probably a little bit muted. And I say that kind of tongue in cheek, because oftentimes I've heard from investors oh, those returns don't meet my criteria. And it's well, all you have to do is adjust a couple numbers in the spreadsheet and we can get you to where you want to be. It's all, pro forma. This could get pretty fluffy fast, but in this case, this is just a little too low given the market, given the asset class and the risk.
Thing for me is understanding how is it a 2 multiple and a 12% IRR? I'm okay with a 12% IRR if that's what it is. And the deal is conservative. I'm happy with it, but I just don't understand how you also get a 2x there. So this is one where I'd delete, but I'd probably put the operator on my list of I would like to follow them. I don't know why, but Louisiana makes me nervous. Maybe it's hurricanes. Maybe it's, who knows what's going to happen there. All right, we'll move on to the next one. This is a distressed real estate deal with 30% discount. Capital Raiser sending it through an operator that I know both of them. It's a 248 unit multifamily in Garland, Texas, which is a B+ submarket of Dallas, surrounded by Fortune 500 employers. The seller is in distress and taking a $13 million loss, wiping out most of their investor equity. They're acquiring it at a 30% discount from pricing that was just 2 years ago. 88% of the units are primed for renovation and significant upside through added in unit washer dryers. Texas Instruments headquarters is near there. That's what we have. What do you think, Paul?
Did they talk about what the vintage was in the property?
They did not.
Anything about occupancy?
No, they said 88% of the units are primed for renovation, but nothing about occupancy. So we don't have a whole bunch of info on this one.
Did they talk about how much they need for CapEx?
Nope.
Okay, so we've got some questions to answer here. I would say I am interested. I would want to talk to the sponsor and find out exactly what the scenario is. If they're getting it at a 30% discount to the peak, that might mean that it's at fair market value today, or maybe slightly better. That's of interest. Ideally, if it's better than what they could get it at if it weren't distressed. So yeah, I guess that's where I'd start, is just a conversation with the operator. I want to know the story. This is the kind of stuff that I've, was thinking might be coming back in 2023, early 2024. It hadn't hit the market yet. We're starting to see a little bit more of it now as lenders decide that they don't want to extend and pretend terms anymore, and they're ready to, either replace operators or foreclose on property. So I'd want to know what the scenario is and kind of understand, what the track is to get this property performing again. Oftentimes when equity is wiped out like this, the in-place syndicator kind of gives up on the asset and things can go really quickly south. So knowing what you're walking into, if it's 50% occupied, that's a much bigger risk to take on as an investor than if it's 95% occupied and, there's a property management company in place handling everything. So those are all questions to address, but it's interesting.
Sometimes the marketing turns me off, and part of this is significant distress, rare opportunity, off-market deal. You're saying all this stuff, and maybe when I click in and go to the actual deal, all of that will be apparent, but it seems like the deal should speak for itself. One of the things that kind of turns me off about this one is significant upside through added in unit washer dryers, right? We've heard this one before, and I get it. You spend $1,000 on washer dryers and you can charge another $100 in rent. Well, that $100 goes directly to net operating income, which increases the value of the place. But if you have 248 units, and washer dryers is your significant upside, that doesn't seem like enough. Sometimes you talk about, well, you put in a pet fence, you put in a washer dryer and all that, and that's great, but that doesn't give me significant upside. Now, if they redo 88% of the units, maybe. I guess I'm also a maybe on this one. The fact is that this operator also, is doing a deal or two a month. So when you look at that volume and then they start talking about this is a rare opportunity and things like that, it just kind of feels like I'm being pushed a little bit into something that, if every one of their deals is a rare opportunity in a distressed asset, then are any of them? That would be my question.
Yeah, that's fair. 1 or 2 deals a month, that's scaling at a rapid rate, which is always concerning.
And they're in different markets, and they've been, successful so far. They're starting a few capital calls here and there from deals they did in 21, 22, but they've been buying deals throughout. So interesting deal. I would probably be a watch and wait. I don't know. I know this is dig in and delete, and watch and wait is kind of in the middle, but that's kind of where I am on this one. What do you think, Paul? Are you dig in or you delete?
I dig in. I'd want to know a little bit more. I just think these distress scenarios are kind of fascinating, and I think there are some certainly diamonds in the rough that could come from keeping your eye on the ball here. So not necessarily this deal, but other deals that have similar characteristics. Just finding out more details would be where to start. And the more conversations you have around these types of scenarios, the more you're likely to know when you find the right one for yourself.
I think it's hard because all of these are marketing pitches that are being sent to us, right? And so you got to decide, am I going to get through all the words? And on that one, the words tripped me up because it was selling it too hard. But then if I do dig in, I might find out that all of that was exactly true. And this is a rare opportunity. This is super distressed. All these things can happen. So I need to set aside my, the bias and maybe jump into some of these. But also sometimes it's just, the marketing didn't work on me and I'm moving on. So you got another one for me, Paul?
Sure do. We could keep going all day on this. I've got FlexSpace Fund.
Okay.
This is a operator who I know is involved in other asset classes. So this isn't necessarily their core competency, but they're getting into the flex space and they're doing it with, looks like a blind pool style. One of the most sought after asset classes in today's market. I wouldn't disagree. I think there's some real opportunity in this space. There's not a lot of square footage for lease, a lot of demand, and it's difficult to build like it is with other asset classes. So whatever is available gets gobbled up pretty quickly. But that has obviously driven interest into the space now, and cap rates are compressing with this multi-tenant kind of small bay industrial. Let's see what else we've got here. It looks like they're going to be taking on 65% leverage. They have co-invest of what looks like about 5 to 10%. The rest will be coming from limited partners, 8% current preferred equity return. I don't know if current means current pay, like they're going to be able to pay that 8%, day one. 2x project multiple, 70-30 split. It's a total fund size of 10 million, 5-year sell or refinance. They're taking on qualified money if you want to invest through an IRA or the like, and $50,000 minimum. 20 plus IRR.
This one seems fairly easy for me, and I'm a delete. And again, funds are very hard to do this exercise, dig in and delete, right? Because it's a blind fund. But what struck me is you said they haven't done this before. It's a blind fund, so I don't even get to see unless I, maybe wait 6 months and see what kind of assets they're getting in there. But it's also a very small fund. It's only $10 million, right? We're seeing funds of 50 million, 100 million. So even if you wait 6 months, it might be closed because they buy just a few assets and the fund will be done. But the issue I have is the operator hasn't done this before. I would prefer, if I'm going to invest in an operator that's doing something for the first time, which I don't generally want to do, I've gotten burned by that, I would prefer it to be a single asset syndication rather than a fund. I would also want to know, did they hire someone with experience in this? Because that changes the dynamic a little bit. But again, stating that blind funds are difficult to do this exercise with, I probably would just pass on this because of the lack of experience of the operator in this asset class.
To your comment about hiring somebody who knows what they're doing, I can't state that as fact, but I do see a name here that I recognize who I think has some experience in self-storage, and this is not self-storage. It's somewhat similar, I suppose, but it is a different asset class. They're kind of subcategories: flex industrial, self-storage of industrial overall. So maybe, collectively as a team, they've got the resources to pull this off, but I share that concern. And I always get, a little weary of people hopping around from fad to fad, so to speak, and chasing the shiny object or whatever's hottest in the market. I think it's okay actually from a investor standpoint, if we're LPs or even funds, and you're allocating into individual investments based on a thesis. And, I talk a lot about being nimble and not trying to jam a square peg through a round hole. So I kind of talk out both sides of my mouth a little bit here, but if you're syndicating and you're the lead operator, I think you need to have a focus and an unfair advantage and a core competency that you kind of run with long term. And from what I can tell about these guys, they've kind of popped all over the place. So I'm not confident that my money would be put to good use. I may give them a shot if it was like a single asset type deal where it's like, hey, this is new to us, but I can underwrite the actual asset that they're acquiring and kind of get my hands on the business plan and understand a little bit more. This is just wide open. Hey, we're raising all this money and we're going to go out and we're going to buy whatever we want. So that to me always makes me nervous. And I haven't only invested in a couple blind pool funds, and neither one of them is performing to pro forma.
All right, we'll do one more. Looks like we're mostly deleting stuff today. And I think that makes sense, right? Because we're trying to get through our inbox. Since we've done this the last time, it's been, 6 weeks. And I've probably had 50 deals that were in this folder that I saved. And so just kind of winnowing through them is difficult. But you don't want to say yes to too many, because then you're digging all day. So we got one more for you, Paul, and it is a 246 Class B unit multifamily. It is in San Antonio, Texas. They're buying the deal for even less than the seller's all-in costs, purchased 5 years ago, ! 2007 construction, excellent condition, minimal deferred maintenance, off-market acquisition, bolded, $132,000 a unit, nearly 28% below recent submarket comps. Northwest San Antonio, one of the tightest and most affluent rental corridors in the city. I don't know what that means exactly. Conservative value-add business plan targeting $225 rent bumps, 5.5% fixed rate Freddie Mac debt, 2 years interest only. I don't know how long the term is. Projected cash on cash of 6 to 8%. And this is the next one that I'm not sure about. 26 to 29% AAR over 5 years, 30 to 50% bonus depreciation in 2025, and 8% pref. It's already stabilized and it has upside. It is not a turnaround project. So, Paul, what do you think?
How are we getting 26 to 29% AAR? The IRR is going to be lower than that, probably in the low 20s. Why are they even using ARR if they're advertising?
No idea.
And they mentioned that it's stabilized too, so there's not a lot of value to drive here, but the returns are that high. It's not a red flag, but my guess is I get the underwriting file and be disappointed in what I see as far as the inputs and what they've underwritten to for rent growth and expenses and all those things. So for me, I'd say I've seen enough of those types of deals and I'd probably pass and not waste my time. That's just me.
This is crazy, right? Because why did I put this in here when I had 50 other deals? Why did I pick this one? And why am I going to say delete? It's because if they had put a 20 or an 18% average annual return, I'd be like, okay, this sounds good to me, right? But they put 26 to 29. I'm a no. I don't believe you. Now, if I had time to dig into every deal that was sent to me, maybe I dig into this one and I look at it and the rent comps make sense. It's, mishandled or whatever, why they're buying it. But, this is part of the process for me is if you're going to say these wild numbers, but nothing in your email pitch says why those numbers are wild. Everything else in this email is just basic. This is your basic deal, right? Yeah, it's 28% below recent comps. Great. They purchased it cheaper than they did 5 years ago. Great. But does that mean you're going to make almost a 30% return? I don't believe you. And I think my point is if you're going to say those large numbers, then in that same email, you need to give me a couple of reasons to believe it. And then I can dig in because I would love a 30% return. Let's do it. But I don't believe you and you didn't put anything in the email to show me. And the whole point of this is to get me to dig in. And the 29 makes me say delete. So their marketing went the opposite way they intended for me.
Yep, I feel the same way. It's unrealistic. It's not consistent with what's going on in the marketplace. If there was some sort of story advertised that, hey, there's a distress scenario or there's so much upside here because of XYZ story, maybe you can arrive at those numbers somehow. But to say it's stabilized and just because it's in a good area of town doesn't mean that it's going to generate those kind of returns. So, if it was in a good area of town, they may have been in a bidding war and they had to really get aggressive on their assumptions to arrive at a deal where they would get awarded from the broker. To me, it seems like an overpay type scenario and overpromising and going to potentially underdeliver to investors. What's going on in the market right now for stabilized newer product? I mean, you're looking at low teens returns probably over 5 years. If it's an older vintage, there's got to be some sort of value add upside, and anything above like an 18, I would really start to question what they're projecting. So 26 to 28 AAR is way out in left field. No pun intended.
All right, Paul, well, that was a great episode of Dig In and Delete. As I said, I think we deleted more than we dug in, but we found a couple of good ones, I think.
Yeah, that was fun. I always enjoy seeing deal flow that's not hitting my inbox and getting the opinions of others. So your insights have been appreciated.
Yeah, same. And it's remarkable how many we didn't have that crossed over, right? I mean, we have yet to find the same deals. So that's fantastic. That's a wrap for today's episode of Dig In or Delete. We hope breaking down these real deals helped you sharpen your own filter for what's worth looking into and what's worth deleting. And remember, let us know what you think of this format. Should we do more of these? You can share your thoughts in the forum on PassivePockets.com or email me directly at jimpfeifer@BiggerPockets.com. We would love to hear what kind of deals you're seeing in your inbox. Remember, you can start your 7-day free trial to PassivePockets.com today. Thanks for tuning in, and as always, happy investing.